The Trump administration's proposed tariffs are targeted at Indian goods from textiles to engineering exports if New Delhi continues buying Russian crude oil in large volumes. According to data from India's Commerce Ministry, Russia accounted for nearly 36% of India's total crude oil imports in 2024, a sharp increase from just 2% in early 2022 after Moscow began offering steep discounts following Western sanctions. India, long dependent on Middle Eastern oil, has strategically diversified towards Russian crude since 2022, taking advantage of the competitive pricing and securing energy stability for its fast-growing economy. While Washington frames this as undermining its sanction campaign on Moscow, New Delhi views this as safeguarding national interest and shielding consumers from volatile global prices. Trump is now looking to penalize India financially, not by directly stopping oil purchases, but by making Indian exports to US more expensive and less competitive. Hello and welcome, I'm Shivani Singh, and in this segment we will understand US tariff threat on India for importing Russian oil, what it means for Indian economy, the tough choices ahead, and whether India can actually walk away from Moscow's barrel without hurting its economy. New Delhi has two broad options. First, to keep importing Russian oil, secure cheaper barrels but risk higher US tariffs on goods which could dent a market worth over $80 billion in bilateral trade annually. Second is to reduce dependency on Russian crude to avoid tariffs, but that means sourcing more from the Middle East, the US or Africa at higher prices. Indian refiners have been buying Russian Urals crude at discounts of $6 to $8 per barrel compared to Brent. Cutting that supply means paying global market prices, adding billions to the annual import bill. According to estimates, a complete shift away from Russian crude could cost India an additional $3 to $5 billion annually, potentially rising to $7 to $11 billion in a stress scenario. And while Indian refiners can technically operate without Russian oil, they've done it before 2022, the trade-offs is higher inflation at home and higher pump prices for consumers. If India wants to soften the blow while reducing Russian imports, there are three main options: boost purchases from Middle Eastern suppliers like Saudi Arabia, Iraq and the UAE, though at steeper prices; buy more US crude, which could ease political heat, but higher freight and logistic cost could make it pricey; turn to African producers such as Nigeria and Angola, though these markets are less stable and offer limited volumes. Still, none of these alternatives can match the combination of steep discounts and steady supply that Russia currently provides. If India moves away from Russian oil, the impact could be sharp. Analysts estimate an additional $3 to $5 billion in annual crude cost, widening the trade deficit. Higher energy prices may also translate into inflation pressure, though RBI data suggests that for every 10% rise in global crude prices, retail inflation could rise by around 0.2%. Now, if India chooses to ignore US tariffs, key export sectors such as textiles, pharmaceuticals and engineering goods could face steep hikes, a move that may hit millions of jobs tied to exports. The ripple effect could go beyond trade, straining political ties and spilling into the pillars of US-India cooperation from technology to defense. So India's decision comes down to paying more for oil now to protect exports, or keep the cheap Russian barrels and risk losing US market share. Either way, the cost will be high. The question is, which cost can India absorb better? We'll continue following this story closely. Stay tuned to Money Control for more global updates. See you in the next report.